Well, hi, and welcome to our continuing series of live stream panel discussions for high growth startups, a partnership between Fourthly and Foley and Laudner. Each week on Wednesdays, we have a panel discussion featuring attorneys, venture capitalists, and startup founders, talking about how startups and investors can navigate all the different legal and regulatory issues that startups may face today. Today's topic is the art of the belly flop. What happens when a startup founder is faced with raising money on difficult terms? How should they think through term sheets that may have some onerous parameters? I'm Brett Waters. I've been immersed in the startup world of Silicon Valley my entire life. Today I teach entrepreneurship at Stanford University. I coach startup CEOs at Miller Center for Social Entrepreneurship, and I run the Fourthly Startup Accelerator. Today we have two amazing guests to talk about this stuff. The first up is Danielle. Morning, Danielle.
Hi, Brett. Thanks for having me again.
Give us the brief backgrounder on you.
Yeah, so I'm a partner at a fund called WVV. It's a $100 million fund based in Silicon Valley in the Midwest. We are backed by four corporates. So we work with Johnson Controls, Foxconn, Advocate Aurora Health, which is a large health system, and Northwestern Mutual. And so between the four of them, we make early stage investments in companies that may be able to work with any one of those LPs either now or in the future. And prior to that, where I met you, of course, is when I was building an accelerator called the Alchemist Accelerator, which is an early stage B2B accelerator based in Silicon Valley. And I spent 7 years doing that as the managing partner and COO. Been in and around for the last 10 years, I guess. It's gone by quickly, but good stuff.
So 10 years. So that means you were 9 when you started. Is that right?
Don't give it away.
And also here with us is Louis. Louis, is your audio work?
He's signing to us now. See, I told you, Brett.
No audio. Mm-hmm. All right. Well, while Louis works on his audio, let's just go right into to our discussion. And folks, if you have any questions for our panelists, please put them into the chat box, and we'll get to as many of those as we can. And if you know sign language, that'll be helpful for Louis.
How about now?
Yes.
We got you now, Louis.
There we go. Okay.
There we go.
Technology challenged lawyer, Louis Lowe.
That's right.
It's great to have you both. I am a groupie of Brett's, not just at the taco stand, but in life. And Danielle, I've had the pleasure of knowing and working with. And it's just delighted to have you all. And, as Brett and I were talking about how to put together some content that would speak to our audience of startup founders, we're really having to come to terms with the fact that we're in a new world since a year ago. And we want to set the stage that we're not going back. We're going to go forward, and it's not going to be all bad. It's going to be good. But we thought we would try and have a conversation about what's really happening with cap tables and term sheets and new financings, and hopefully give you some advice about how to think through it and get ready. Because sooner or later, we're all going to be there raising funds again. Brett?
So Louis and Daniel, I had the experience a few years ago at a startup. I raised a $5 million first round on terms that I was pretty happy with. I gave away 20% of the company for $5 million, and terms were decent, and I was pretty happy. And then a couple of years went by. We did not hit our numbers, and the fundraising environment changed pretty dramatically. And so I ended up having to raise a second round just to stay alive. I had to raise a second round kind of on whatever terms I was offered, which was at a much lower valuation than I was hoping. 2x liquidation preferences, and the dreaded full-ratchet. And when we finally sold that company, and of course I considered it a win that we found a buyer for the company and sold the company. And my final distribution check was $83. And my goal here today is to serve as a cautionary tale for others. So, as Louis kind of alluded to, it's definitely a different fundraising environment today than it was a year ago. A year ago, the entrepreneur kind of had all the leverage, and the entrepreneur could set the terms. And today, it's kind of reversed. Even though there's still a whole lot of money out there, there's no shortage of capital available waiting to be deployed. But the market conditions are such that it's often being deployed under terms that are much less favorable to the entrepreneur. So the two of you are very much on the front lines, much more on the front lines than I am these days. Danielle, you're busy meeting with entrepreneurs and doing financing, and Louis, you're busy handling a lot of financing for startups throughout Silicon Valley. So maybe we can start just kind of with what you're seeing right now, and to what extent is it different than a year ago? Danielle, you want to go first on that?
Yeah, sure. I feel like I've been having this conversation a lot with folks just because it's been the same for everyone in the VC world, especially for the stage that we do, which is seed, Series A. So I like to frame it in this kind of way. Everything was going pretty ridiculous in terms of valuations, up until maybe January even. And then we got this point where we were all coming back from the holidays. We thought things were going to continue, but then everyone got COVID. If you remember, there was that wave of, COVID 3, I don't know, come January. And then we're like, okay, so then we came back in February, March, and we're like, all right, we're ready to go. It's springtime, usually a busy time for VCs. But then the war happened, and then inflation started, happening. And everyone just took a pause to kind of see where the macro environment would lead. And that actually, fell into the private markets in a good way, I think. But it adjusted the valuations back down, and so we've been seeing that that adjustment happen through a few last few months. But then everyone went away for the summer, and so here we are in September.
Right.
I think finally in a better environment where investors feel like they're getting a good deal again. But founders are in a hard spot because maybe they raised on really high terms recently, and they're taking down rounds, or they realize that, they're not going to be able to hit their numbers against the valuations they did raise at. And so now they're having to come up with exit strategies before maybe they thought they wanted to. And so that's it. It's definitely been, let's say, a slow year for a lot of VCs. I know I know there have been deals done, but a lot of us have just been kind of waiting and seeing how the markets would even out. And I think we're finally at that point. And we have, as you put it, Brett, we have capital to deploy. And so I think there's going to be a lot more movement this fall. And by fall, I mean this month and next month, maybe into November, because then everyone leaves for December.
Yeah. So as many in our audience probably know, there's a running joke in Silicon Valley that there's no way to raise money in August because all of the venture capitalists are gone in August, and then, as Danielle said, then they leave again in December. So we've got a 90-day period here now where the checkbooks may be open. Louis, what are you seeing out there?
I think different than prior corrections, because notice I didn't say recession. We are at a time where there are funds out there, institutional funds, Sand Hill Road, Soma funds, corporate venture funds, and all sorts of sovereigns and financial institutions that are doing direct investing. And there is more capital that has been earmarked for venture than ever before. So that's the good news, number one. Good news, number two, is returns have been fantastic for this asset class. And so we are not hearing any of our venture funds hearing from their own limited partners, hey, pull back, we don't want you to spend, don't call our capital. We are not hearing that. Quite the contrary. LPs are wondering, where are my returns? And so that's also good news. I'd also say that there are a class of new funds who are not what I'll call, bared down by the high valuations of prior years where things might not produce the best results. Uh, and so I think that there's really this really should be a golden time to create a startup and build. We're also in a time where the government has deployed more capital to innovation than ever
Yeah.
before.
Yeah.
Just 2 days ago, our president announced the moonshot and devoted more cash towards it. We've got the Inflation Reduction Act, which is earmarking a lot of funds to clean energy, and obviously the CHIPS Act. So we may have a chip industry again in Silicon Valley. So again, a golden time. So that's the good news. The bad news is, Brett and Danielle, as we all know, that starting in January, the market started anticipating, seeing inflation and anticipating more inflation, and thus interest rate increases, and more and more and more. And just yesterday, there was just a rout in the public markets as some unfortunate inflation data for the month of August got published, and things are not slowing down. Employment data is still showing that it's the Great Resignation of quiet quitters. Means that we just can't get enough staff to get going. So what are we seeing in venture? So what's the first thing? Well, as Brett and I always say, this is happening in high resolution, folks. So whereas when Brett did the startup, he mentioned, funding rounds happened, 2 or 3 years apart. Today, I think funding happens every year. And so, it's time to deal with it now. When you're going to be raising, it's not going to change. And so you have a couple of choices as I see it. And the first is, do you do a convertible note bridge round, which is what Brett probably did all those years ago. It probably has a 2 to 5x liquidation preference. It has a ratchet. It's ugly. Let's not go there, but that's probably what your venture investor would like to do because they get a nice bump. What we're seeing a lot of startups do is just like what they've been doing. They say, well, let's raise a safe round. And the first thing I want to tell you is if you've raised equity, your safe is subject to the preemptive rights. It's a convertible security, most likely in your equity docs, that is subject to a preemptive for your existing investors. So you have to offer it to everyone. The cap may be lower than your last round, and then what do? Do you just let it go and figure the anti-dilution will be dealt with when you convert later, or do you extend the existing round? We're seeing lots and lots of extension rounds. I put a blog post out about this yesterday, about how people are saying, you know what, let's not even talk about safe because there might be a discount or a cap. Let's just say, hey, we're reopening the last round, same terms. You're going to get last year's valuation. Isn't that great? And investors might think that's terrific because the company would have progressed, and yet they're getting the same price. It sounds really good, except if valuation has gone down, well, that's maybe not the best deal. So obviously the other alternative is to do a down round where you actually raise equity at a lower price. The anti-dilution protections for the prior investors are going to kick in unless they waive them. People ask me all the time, what does that look like? And I say, don't even go there. Nobody's waiving their anti-dilution rights unless it's a pay-to-play kind of situation. So Brett, I've kind of laid out what I see as the meat and potatoes of what are the choices when you need money and you've raised some capital and what are the consequences?
Yeah, thanks for that, Louis. Let me also say that as Louis and Danielle were talking about the current state of things, is very stage dependent. So you guys correct me if I'm wrong, but from what I've seen, later stage is definitely slowed down, whereas early stage is still cooking along. Is that approximately what you guys have seen too?
I'm seeing late stage running very smoothly across my desk.
Okay.
And got a double unicorn just 2 days ago. So
but there's not much of an IPO window right now, and so
that's true.
So for later stage, the kind of the path to liquidity is very unclear, whereas early stage the time horizon's long enough that we're less concerned about the path of liquidity right now.
Yeah, I'm curious to see if we will have an IPO market in the fourth quarter. The information put out a guide to the 40 companies that are in the queue, and
Yeah.
it looks pretty good. I mean,
Yeah.
you still got Stripe out there,
Yeah.
some really great names that should trade really well.
Right.
If we can
Right.
get them
Yeah,
out.
I saw that too. By the way, a little plug for Jessica Lesson's The Information. It's a great publication. It costs a bunch of money, but I think you can get a free trial or something. So check it out, and check if you go to theinformation.com. Check out what Louis is talking about. They've got an IPO pipeline of all the different companies that they believe are kind of in the IPO pipeline and where they are in that process, which is pretty interesting. So, Danielle, when you guys have partner meetings, do you talk about the ways in which you may be adjusting term sheets in the current environment, or?
Not necessarily. I mean, we don't. All of our LPs are also investors, and so they're also seeing it on their end as well,
Yeah.
and have a good idea about the trends. If anything, we discuss negotiations. Things that we have more leverage now than we did maybe
Right.
a year ago.
Right. Right. But is that mostly to show up then on the valuation?
It is. It's definitely around the valuation.
Yeah.
I mean, at the end of the day, you want to, for founders, you want to find an investor that's going to be a good partner to you, not someone who's looking to take advantage of you. And so if they are just, I mean, it depends on your situation. If this is your, last hope, then you're kind of stuck in a hard place. But
Right.
Hopefully you've had a chance to get a couple of term sheets and see the different terms and find a good partner that's not putting in all these excessive terms on you, so you can actually build a big business.
Yeah. Right. So as always, you want to be in a position where you're looking at 2 or 3 different term sheets and deciding on the one that's the best fit for you.
Mm-hmm.
It's just like dating, Danielle.
It's just like dating, Brett.
Danielle's recently married, by the way.
Thank you.
Louis, sorry I cut you off.
No, I was just going to say, maybe worth a word about some of the new terms that you ought to be on the lookout for.
Yeah.
We're seeing liquidation preferences being more than 1x the original issue price across the board. So what does this mean? Well, when you invest equity, normally the preferred is going to get its money back before everyone else one time upon a sale or an IPO or any kind of conversion. And a lot of investors are saying, okay, I'm gonna stretch to this valuation that you've asked me for, but I'm really stretching, and so I need to make sure I get my money back, but I also need to make money. And so rather than just get my money back, I need to get my money back 2 times before you, the founders, get your money. And so a 2x liquidation preference, I'm finding, is creeping its way into a lot of earlier stage term sheets, and it's absolutely in late stage term sheets. Yeah. So all of these late stage, big deals are absolutely having multiples of lick pref at 2.5x.
Right. And just to really put a fine point on what Louis is saying, if you were to raise $5 million, for example, at 2x liquidation preference, that means that when the company is sold or wound down, that the first $10 million goes to those investors before a nickel goes to any of the employees or founders. It's a super important concept to keep in mind. And the difference between 1x, 1.5x, 2x is pretty substantial.
Right? And I want to give the antidote to those founders out there. The antidote can be that you also have a management carve-out plan such that the first 20% or some percentage of the sale of the company goes to management. And you can put that in later when there's actually a sale going on to make sure that the founders do get something and not, something more than $83 in a taco.
Maybe a margarita.
Maybe a margarita as well, right?
So we work with founders a lot on those kinds of things. And I think it's important to think through all of these things before you go out there, because When you talk to somebody like Danielle or Brett or myself, we can look at a cap table and your recent results and kind of guess what that's going to look like when you have a conversation, and coming out in a very realistic way when you talk to an investor goes miles. The first thing to shut them off is, oh, okay, you raised at that valuation last year. Okay, I don't even want to have that conversation. But if you kind of preempt it with, hey, we know things are different, and here's how we're thinking about it. A safe with a cap here, or some other antidote. I think you can really have a better discussion.
So one safety tip that Louis just gave us there, which is a good one, is that if you're entering into a financing that is going to be kind of painful for the founders and management with regard to their equity, that asking for a management carve out is a potential solution to that, meaning that everybody's going to get diluted, but a little extra is going to be carved out for management. And usually, my experience is usually those conversations go fine because investors want the management to be highly incented, right? I mean, if the management is crammed down to very little equity in the company, that is not in the investor's best interest.
Yeah.
So they're usually open to having a discussion around stuff like that. So Dan asks in chat that he says that sort of some VCs don't care about small little terms like liquidation preferences.
I mean, I think it's pretty standard to have a 1x liquidation, whether they've increased it or not. Again, I feel like it depends on the VC, whether they think they have the leverage to, or maybe they've just been hit so hard that they're like taking no risk. It's interesting because the game of VC is that you are the risk taker, and so there's a line, right? I think that, if you're playing VC like you would venture debt or something, then you might want to think about a different business, because this is how it goes. Things are not always going to be easy. The markets are not always going to look amazing, but we have to have faith in that. History shows that the venture returns are there, especially for those that are willing to take the risks in the harder markets. And yeah, sometimes it doesn't, a lot of times it doesn't pay off, and sometimes it pays off really big. I consider this to be a game of luck. I wish somebody had the magic wand and knew, oh, this one's going to work and this one. I mean, we all have our, things that we look for, that we think is the winning combo, but yeah, it's everybody's game.
And I think another answer to Dan's question is that all of these things end up being negotiated, right? And so, as Louis said, maybe at this valuation they're fine with 1x liquidation preferences, which is kind of the standard. I mean, there's always going to be 1x liquidation preferences, but if you try to really negotiate hard for a high valuation, they may say, I'd be willing to do a higher valuation, but then I'm going to want 2x liquidation preferences. So all of these things end up being parameters that can be negotiated, in my experience. Is that right, Louis?
Absolutely.
Yeah. So let's see. So what are the other, Louis, in your experience? So you mentioned management carve-outs. I guess, what advice would you give an entrepreneur today who is shopping around for money, and maybe they've got 3 different term sheets and they're trying to, compare them. How would you prioritize the things that an entrepreneur should really look for? In other words, what are the really important things in your mind?
Well, I think Danielle said it before. First and foremost, this is a relationship, and this is going to be your partner in the business going forward until you sell it. And so it's got to be somebody that you feel like you have some alignment with in terms of vision, mission, horizon, and where you're taking the company. And that's a question of art, not of science, I would say. The second is whether this fund is known for taking up their pro ratas and committing to the company round after round. There are some funds out there, who are not designed to reinvest in the B and the C. They're one and done. And those are not necessarily, they can be great syndicate players, but not necessarily lead players. And so I would think about that. I think some VCs can really help you in your business. I'm thinking of, a corporate venture, for example, could be a channel partner. It could give you a leg up with a business unit, potentially. Lots of health warnings there that we can talk about on another episode, Brett. But so I think about that. And then I think on the terms, I like to see a clean term sheet. The ones with all the, pages of extra details or terrible conditions, I'm a little bit suspicious of. That being said, I think investors are really trying to stretch to meet the valuation goals of the founders, and they're trying to put in protections so that they're if things don't go well, that they get their money back. And so some of those things I'm finding are a lot more conditions about diligence, talking to customers before they close. I'm also seeing these, as I said, liquidation preferences at greater than 1, or you go into the convertible note of the safe, and I'm seeing more than 2x as the return of capital upon a change of control. So in the form of safe and in most convertible notes, if you sell the company before you convert people in an equity financing, they get a 2x. That's usually a reward for having been the capital that led to this very risky capital that led to this great outcome. And so I'm seeing investors look for more than 2 there, and then I'm seeing a lot of control rights, and I'm not yet seeing the ratchet, Brett, that you referenced.
Good. I'm glad to hear that.
Yeah, I'm not seeing that, and I hope never to see it. It's an ugly thing.
Yeah.
So, Louis, you mentioned control rights. Let's talk about that for a second, because there's kind of this mythology out there. Some people think that those damn VCs, what they really want to do is take over my company. And you got to be careful with VCs because they just want to take over your company. And of course, in my experience, the last thing a VC wants to do is take over your company. That's just not the business that they're in.
Yeah.
Right.
That's kind of the worst case scenario, is that they have to take over your company. They're in the business of letting other people run the companies, and the VC gets to profit from the hard work that the entrepreneur puts into it. That's the business that they're in.
Exactly.
But you did bring up control rights, so kind of talk a little bit about that, Louis, in terms of, again, from the perspective of an entrepreneur. What are some of the control rights that one might see, and how do you think about that?
Yeah. So the first right that we see in an equity term sheet will be the voting rights. How much of an equity percentage or a vote that they're going to get, and then what specific items are going to require a vote of the preferred investors. So you'll have a list there, and then secondarily, there may be a board director seat or a board observer seat. And during the heydays of the boom, we saw a lot of venture investors sort of letting go of that and relying on their relationship with the founder to get all of the information rights and to be able to kind of supervise and know what was going on. We're seeing now that investors are taking pains to look at what's the board composition. Are the founders a majority? Are they not? And the new investor, making sure that they have a seat at the table. And then lastly, we do see investors now inserting conditions like, we want you to get a CFO, we want you to get a general counsel, we want you to hire a head of sales, because if you're going to take this money to grow, we want to see you do that in a methodical way with somebody who has a process and a plan. So those are some of the things that we're seeing. Brett, I'd be curious, Danielle, what's happening in your world in terms of governance?
Yeah, honestly, I mean, I'm listening. You see way more term sheets than I do these days, but for us, I would say that VCs are trying to protect their early stage rights, in the subsequent rounds. I think nothing is guaranteed anymore. So, if you got pro rata, if you got a board seat, honestly, it feels like every round is up for debate, and VCs have to fight for the things that were already agreed to. Um, you know, and it does come down, you would like to think it comes down to the relationship, but when it comes to a matter of survival and somebody is dangling, $20 million in your face, sometimes it doesn't matter. So, I think VCs are, especially for the earlier stage VCs, I would say, the more well-known funds, the larger funds, they probably don't have this problem, right? People want to make sure that they stay happy, just because they have deep pockets. But for the smaller funds, we still have to work at it, and we do take our portfolio companies very seriously. We're making sure we give them the attention that they need when they need it. So it's I think it really comes down to that. But term sheet wise, we haven't seen anything. There was an interesting clause that just came up, which was a diversity clause. That was the first time I'd ever heard about that, about, a lead investor, putting in a diversity clause to make sure that there was, diverse representation, not just with the management team of the company, but also with the investor set. So that was interesting. And I don't know if you're seeing any more of anything like that, Louis, but yeah, that is something that just recently came up.
That is a great point. And Brett, maybe we should do a session on ESG. But the National Venture Capital Association a few years ago, really got religion on the fact that venture has not been historically a very diverse industry, and that they had some responsibility to making sure that their portfolio companies were putting some structures in place to do good. And so there is a diversity policy that's been in that National Venture Capital Association's put out and is now in the form term sheet, and lots of other what I'll call ESG types of flavors, depending on the vertical and the company that they're walking into. Also, anti-harassment policies, and other things to kind of make sure that things are not going haywire, or inside the companies once they get the money. But I wanted to go back to this question, Brett, that you asked about what governance rights. What I described was what you see in an equity deal, and for a lot of you out there, you've raised a lot of safes, and as we all know, safe is just a simple agreement for future equity. There are no voting rights at all. And recently, maybe 3 months ago, I saw a side letter that came alongside the safe, and it said, this is great that your YC safe, and this letter hereby amends it such that if you haven't converted me in 3 years, you pay me back at a 2x.
Oh.
Number one. Number two, it asked for information rights, which I think is fair game, as these venture investors need to be able to be able to report to their limited partners, and they need financial information in order to do that. And then I've seen other deals where you get the safe, and of course there's the pro rata side letter, which says they get a pro rata piece of future safes, but it says I get a board seat, and here's the voting agreement. So even though I don't have a vote, you promise to vote me on your board. So those are some of the things, the increased governance rights that we're seeing venture investors ask for when they invest in the super early seed stage or pre-seed stage with a safe or a convertible note, Brett.
It's like a safe with a note twist.
I was going to say, I thought the whole idea of a safe was to get away from convertible notes, but a safe with a repayment obligation is a convertible
it's
note.
a convertible note. Yeah, that's what I was just like, sneaky VC.
Exactly.
So Richard asked a good question, which is that, should I just wait until the environment gets better?
Yeah, I get that question a lot, and in fact, many of my founders will say, "Oh yes, I've decided not to go out and raise because it's not the right time." And as I said at the outset, this is a golden age to be raising capital. And every day that you fail to raise the capital to execute on the plan, and you fail to execute on the plan, somebody else is probably going to be thinking of it, if they haven't already, and catching up and lapping you. It happens to me frequently where I'll have been working with a great startup, but I don't realize 3 years have gone by, and then suddenly I'll see another startup doing the same thing, and I'll say, oh my gosh, we're not alone anymore. So no, I think it's a great time to raise capital, Richard, and I think really the question is how to do it smartly, so that you can grow, and maybe it's raising less capital now and kind of staggering it so that you're taking down capital as you need it, tranching it to so that when you take the capital, you're at a higher value point. But I should shut up. What do you think, Danielle?
It really comes down to the kind of story you can tell. I would say it is pretty hard still for founders who go out to the market and we look at how much money you've raised to date and how much ARR you're doing, right? Or how much revenue. And so if the numbers aren't lining up, I do think there are a little bit more conservative investors out there that are looking for those proof points, some way, shape, or form to see, where you are. But to your point, I do think that shouldn't stop you. If you need the money or you're going to die, then you've got to make some adjustments. And so, yeah, rethinking your round sizes, being okay with a much lower valuation based off of a real multiple. Those are some things that you need to take into consideration. I also believe, Ivan asked about business lines of credit. I mean, I wouldn't say from an investor, but there are definitely other avenues for raising capital. There is venture debt. There are, there are bank loans. There are other types of credit, so look at your options. VC is definitely not the only one to get you over the hump. And you know what? There's no shame in going back to the angel route too, right? Like
Yeah.
there are people that may give you smaller checks, but 25K here or there, like that might give you another little bit of runway. So
And, Danielle, the question that Ivan asks is a perfect segue for next week's panel discussion, because
perfect.
next week's panel discussion is venture debt.
Perfect.
And we are seeing an increased number of venture debt deals right now, and partly because for many companies it's preferable to a down round. And I think that's one of the reasons we're seeing more venture debt right now is that in the equity markets you're probably looking at a down round, and so with a venture debt deal there is no valuation to consider. Louis, you want to jump in on that?
Collateral is much. The collateral options are much better now than they've ever been.
Yeah.
Let me jump in on 2 points. One is I want to answer Ivan. Non-dilutive capital is the best. Yeah. So you start with the government. What can they give you? We saw what the government could give us with the PPP a couple of years ago. Next is, next best. In fact, it may even be better revenues from a customer. And so if you can get a customer to commit on a multi-year deal and pay up front, maybe give them a discount, that's a great way of raising capital. I have been seeing some types of angel investors doing these lines of credit, and I would say be careful. These things can add up quickly, and you could lose your company. The people doing this know what they're doing. They're going to take a security interest, and if you have something valuable, they could foreclose. Venture debt, I want to just argue with you, Brett, which I love to do. I don't think venture debt is available unless you have raised venture equity first. Number one. Number two, that you have a year of runway in the bank. So if you think you can call up a venture debt lender when you're out of money and say, hey, I need payroll, they're not even answering the phone. A requirement is, a year of cash in the bank. Now, there is other types of debt, but the type that we call venture debt that roams freely around the valley and it has some conditions. So for about a year now, I've been advising all of my clients who raise equity to look very hard at venture debt and do it right away, because the best time to raise capital is when you don't need it.
Mhm.
Right.
And
Good.
when you don't need it is when people want to lend you money. And a great way of doing that, and I don't want to steal thunder from next week, is getting a commitment from them that for 3 years they will lend you the money. You don't borrow it. You do pay a fee for this commitment, and then you don't draw it down unless and until you need it. And then you pay, you're going to pay high interest. But the upside is that, hopefully that additional runway will get you to a higher ARR, get you a better valuation on your equity next time around. So it was worth the interest. Okay, I'm going to
Yeah.
stop stealing
Yep.
next week's thunder.
That is all good stuff. And as I said, next week at this time, we're going to have a whole hour-long discussion on this topic. And one of the panelists that's joining us is a venture debt, a source of venture debt where they use IP to secure the debt. Now, obviously, you have to be an IP-rich company for that to be an option, but I think that's an interesting thing for startups.
Yeah,
to think
I
about.
actually just gave a talk on all the different avenues of startup raising not too long ago, but I mean, it was doing the research. It was awesome to see all the different options that were available, to startups now, and especially around the debt conversation. It's not just a bank anymore.
Right,
Um,
right, right,
and it's not always like you need to put your house up, or
right,
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 like in order to
right.
get it.
Yeah.
Some,
Well, I'm
but
I'm
I
fond
want to
of
make one
I'm
one
fond of
warning to founders:
yeah.
beware of the personal guarantee.
yeah,
Please do not ever sign a personal guarantee. Sorry, I had to say that.
Especially without checking with your spouse.
yeah, especially that.
Yes, no, I completely agree with Louis that you should almost never give a personal guarantee, or at least think about it long and hard and talk to Louis about it before you do.
Hmm.
Right? That the whole reason that you've set up a corporation is to have a separation between the business obligations and your personal obligations. That's the
Yeah.
reason you set up the corporation. Okay, so I just want to quickly dovetail onto what Danielle said and Louis said earlier, which is that 2022, one of the many reasons why 2022 is the greatest time ever to be an entrepreneur, is that there are more sources and structures available of capital than ever before. There's lots of different sources and structures, and so the main thing is shop around, understand the different sources and structures and which ones align best with you and your venture. And as Danielle and Louis have both said, find capital partners who are on your side and who you want to have them on your side for a while, because it's you're going to be married to them, and it's probably easier to get rid of your spouse than to get rid of an investor, and so think about that, right, Louis?
Not going there with you, Brett, but I want to dovetail back to a question you asked because I didn't get a chance to say the answer. If you're a founder and you're looking at a valuation and it's less than what you'd like, so there's going to be more lick pref on top of you, and you're also going to be diluted. You're going to be diluted in any race, right? What are some of the things we talked about management carve out? But before we would even go there, you hopefully have an equity pool, and there's some amount in there which your existing investors and your new investors will be happy to direct to you to offset some of the dilution. But there can also be a discussion where the new investor says that a condition of their investment is that the pool gets larger and that you get more of that pool, which again would be a second bite at the apple. There's the existing pool and the new pool, which you could get some more equity. So these are things that we spend a lot of time thinking about when we look at cap tables and people ask us about fundraising. The first or second thing is, what about you? And do you have enough skin in the game? And no investor wants to go into a company where the founders only have a de minimis stake, and everybody knows that at some point you're not going to keep burning the candle at all ends for nothing.
Right. All right. Well, this has been a terrific conversation. Thank you, Danielle and Louis. So I think just to summarize here, I think the advice that we've gotten from Danielle and Louis is, first of all, be aware that it's a different environment today than it was a year ago, and accept the fact that you're likely to see term sheets that are different than you would have seen a year ago. But the good news is that there are lots of different sources and structures of capital available, and so make sure you look at all the different sources and structures. try to get more than one term sheet, right? That's key. It's key when you're purchasing anything. It's important to get more than one offer, and then have a good attorney who you can kind of sit down with and go over the various terms of the term sheet and make sure you understand the ramifications of them before you agree to anything. Danielle, anything you want to add to that?
Nope, that was a really good summary, Brett.
Okay, Louis. Thumbs up from Louis. All right, folks, thank you so much for joining us this morning. You can find me and Danielle and Louis. You can find all three of us on LinkedIn. So please let us know if you have any additional questions. Remember that next week at the same time, we'll be having a discussion with a different partner at Foley and a venture debt investor talking about venture debt and kind of the pros and cons of that. Thanks very much to all for joining. See you all soon.
Bye.